Trading psychology. Why most traders lose money. Most traders believe they lose money because they do not have the right strategy. They believe the problem is indicators. They believe the problem is entries and exits. They believe the problem is not enough knowledge. But the truth is much deeper than that. In this video, I want to explain the real reason why most traders lose money, not the reason people like to talk about, but the real reason that quietly destroys trading accounts again and again. If you stay until the end of this video, you will understand why even good strategies fail in real trading, why intelligent people still lose money, and what actually needs to change if you want consistency. This video is not about charts. It is not about indicators. It is about the human mind. If you are serious about trading psychology and long-term success, consider subscribing to Bull Mindset. This channel is about mastering yourself before trying to master the market. Now let us begin. The real reason most traders lose money is not because the market is difficult. It is because trading exposes human weaknesses. Trading puts you in an environment where uncertainty is constant. You never know the outcome of the next trade. You never know how price will move in the next few minutes or hours. And the human brain does not like uncertainty. The brain wants safety. It wants control. It wants certainty. Trading gives none of that. So when people start trading, their psychology starts fighting the reality of the market. This is where most problems begin. Let us be very clear about one thing. A trading strategy does not make decisions. A human makes decisions. A strategy is just a set of rules. But when money is involved, emotions enter the picture. Fear enters. Greed enters. Hope enters. Frustration enters. Ego enters. And once emotions enter, behavior changes. This is why trading psychology matters more than strategy. Most traders already have strategies that can work, but they cannot execute those strategies consistently. They hesitate when they should enter. They exit early when they should hold. They move stop losses when they should accept a loss. They overtrade after losing. They increase risk after winning. These are not strategy problems. These are psychological problems. The market does not take money from traders. Traders give money to the market through poor decisions. One of the biggest psychological traps in trading is the fear of losing money. Losses are normal in trading. They are unavoidable. Even professional traders lose trades regularly. But most traders do not emotionally accept losses. They want to win every trade. They want to be right. They want confirmation. So when a trade goes against them, fear takes over. They close trades too early. They move stop losses. They cancel valid setups. Over time, this destroys the mathematical edge of their strategy. Another major psychological problem is the need for immediate results. Many traders enter the market with unrealistic expectations. They want fast money. They want quick success. But trading is a long-term game. When results do not come quickly, frustration builds. Frustration leads to impulsive decisions. Impulsive decisions lead to losses. This cycle repeats again and again. Another reason traders lose money is emotional attachment to trades. Traders start caring too much about individual trades. They watch each tick. They feel every price movement. They forget that trading is a probability game. No single trade matters. Only a series of trades matters. But emotionally, the brain treats every trade as important. This emotional attachment leads to overreaction. Small losses feel painful. Small wins feel exciting. And emotions push traders to act at the worst possible times. Let me give you a simple example. Imagine two traders using the exact same strategy. Trader 1 follows the rules strictly. They risk a small fixed amount on each trade. They accept losses calmly. They focus on execution. Trader 2 knows the strategy but struggles emotionally. They increase risk after winning. They hesitate after losing. They change rules based on feelings. After 50 trades, Trader 1 is stable and consistent. Trader 2 is stressed and confused. Same strategy, different psychology. This is why psychology is the real difference. Another common psychological mistake is overconfidence. After a few winning trades, traders start to feel special. They believe they understand the market. They stop respecting risk. They increase position size. They take low-quality setups. The market quickly corrects this behavior. One bad trade can wipe out weeks of progress. Professional traders respect the market. They never assume control. They understand that the market can do anything at any time. Ego is dangerous in trading. Another problem is revenge trading. After a loss, many traders feel the urge to get their money back. They enter trades without proper analysis. They increase risk emotionally. This usually leads to more losses. The problem is not the loss itself. The problem is the emotional reaction to the loss. Trading psychology is about learning how to respond, not react. Now let's talk about the illusion of control. Many traders believe they can control outcomes. They believe that more analysis will guarantee success. But the market does not care how much you analyze. You can do everything right and still lose a trade. You can do everything wrong and still win a trade. This randomness is uncomfortable for the human mind. So traders try to control what cannot be controlled. This leads to overanalysis, hesitation, and confusion. Professional traders accept uncertainty. They focus on what they can control. They control risk. They control execution. They control behavior. They do not try to control outcomes. This mindset shift is critical. Now let's look at real trading behavior. Many traders backtest strategies and feel confident, but when they trade live, performance drops. Why does this happen? Because backtesting has no emotional pressure. There is no fear. There is no greed. There is no stress. Live trading activates emotions. This is where psychology reveals itself. Another example is holding losers and cutting winners. Logically, traders know they should cut losses and let winners run. Emotionally, they do the opposite. They hope losers will recover. They fear winners will reverse. This behavior destroys profitability. This is not lack of knowledge. This is emotional decision-making. Now let's talk about how to fix this. The first step is awareness. You must understand that your mind is the biggest variable in trading. Your thoughts influence your actions. Your actions influence your results. The second step is accepting losses fully. Before entering a trade, you must accept the worst-case outcome. If you cannot accept the loss, your position size is too large. Risk should feel uncomfortable but not painful. The third step is shifting focus from money to execution. When you focus on money, emotions increase. When you focus on execution, emotions decrease. Judge your success by how well you follow your rules, not by profit or loss. The fourth step is consistency. Trade the same strategy for a large number of trades. Do not change rules emotionally. Consistency builds confidence. Confidence reduces fear. The fifth step is thinking in probabilities. Every trade is just one event in a long series. No single trade defines you. When you think this way, losses feel normal, not personal. Another powerful mental framework is identity. Stop seeing yourself as someone trying to win trades. Start seeing yourself as someone executing a process. Professionals do not chase wins. They follow systems. Identity drives behavior. If you see yourself as a disciplined trader, your actions will align with that identity. Now let's talk about practical mental exercises. One simple exercise is post-trade review. After every trade, ask yourself 2 questions. Did I follow my rules? Did I control my emotions? Do not ask if you made money. This trains the mind to value discipline over outcomes. Another exercise is loss normalization. Review your trading history and count losing trades. See how normal losses are. This reduces emotional resistance to losing. Another exercise is position size reduction. Trade smaller than you think you should. Smaller risk allows clearer thinking. Clearer thinking leads to better execution. Now let's slow down and bring everything together. Trading psychology is not about eliminating emotions. It is about managing them. You will always feel something. The goal is not to act on those feelings. The market does not reward emotional decisions. It rewards disciplined behavior. Most traders lose money because they never work on themselves. They keep changing strategies. They keep searching for new indicators. But the real work is internal. If you master your psychology, many strategies can work. If you ignore psychology, no strategy will save you. This is the real reason traders lose money. It is not lack of intelligence. It is lack of emotional